The US inflation rate is currently running at 8.6%. If you need an explanation of inflation, it is the decline in the purchasing power of a currency over time. So at 8.6%, $100 next year will only buy as much stuff as $91.4 did this year. Your money is losing its value. Why does this happen? Well, the Texas Public Policy Foundation give a great example. Imagine that Santa Claus writes you a check for Christmas equal to the amount of money you already have. You now have twice as much money. But imagine Santa does the same thing for everyone else. Shortly thereafter, the price of nearly everything you purchase would be about twice as expensive because there's too much money chasing too few goods. Now, I'm sure none of you still believe in Santa Claus, but not too long ago, checks really were given out to everyone. They were called stimulus checks. The IRS had sent out 478 million stimulus checks as of summer 2021 to deal with the economic hardship brought about by the US federal and various state government policies in reaction to the COVID-19 virus. The first round of checks was $1,200 per person, and there were 3 rounds in total of varying amounts. And it wasn't just checks. Trillions of dollars flooded the economy through various other programs too. A lot of these payments did serve to fill a hole while the economy was shut down. However, the government may have gone overboard with the American Rescue Plan, which was a $1.9 trillion stimulus package passed in early 2021 when the economy was already almost fully reopened. Inflation literally started rising right after the American Rescue Plan was passed and has risen ever since. At the current rate of 8.6%, it'll take only a little over 8 years for your money in the bank to lose half its value. And that's what inflation does. It punishes savers, people who keep money in the bank and in fixed value bonds. But it benefits people who hold long-term debt. For example, if you have a 30-year fixed rate mortgage, people around you's rents will be rising and your income will be increasing, in theory, but your mortgage payment will stay the same and thus go down in real terms. But if you have just one mortgage on your primary home, you may not notice it much, since everything else in your life will be increasing in price. It would only be those who hold a lot of long-term debt that would benefit the most. And who is the biggest holder of long-term debt in the whole country? Yes, the US government. The US government is $30 trillion in debt. Around $8 trillion of that debt was added during the pandemic. This may seem like a huge number, and it is, but what is more frightening is that interest rates are rising, and thus it will cost the government more and more money to service the debt. The US government is expected to pay around $400 billion in interest payments in the year 2022, and by 2032 that is expected to rise to $1.2 trillion per year. So the government may be looking for a way to devalue the currency and get out of paying those huge amounts of money in real terms. And this works because most of the debt is a fixed amount. Only 7.5% is issued as inflation-protected securities. So if you allow inflation and the dollar to devalue, prices of products and salaries will rise, and thus so will tax revenues you collect. But the debt will stay the same, and thus go down in real terms. The Wharton School at the University of Pennsylvania estimates that if inflation is running at 5%, the total real-world liability for national debt decreases by 20% by the year 2031. That is equivalent to $6 trillion wiped off the debt. But this inflation makes the average person poorer. In theory, salaries will rise over time, but may not keep pace with inflation right away. However, the even bigger loss is in 2 places: savings in the bank and what is called bracket creep in the tax system. Savings, I think everyone understands. If you just leave money there not earning an interest rate, or even if it is earning 1.6% interest offered by the best savings accounts out there right now, with inflation at 8.6%, it is still devaluing a lot. Then you have bracket creep. Now, some parts of the tax system are indexed to inflation, meaning the thresholds where each tax rate kicks in rises every year depending on inflation. This is the case with federal income tax, but other taxes are not, like net investment income tax and the value of the child income tax credit. You'll end up paying more in investment income tax, and you will get a lower child income tax credit in real terms. Capital gains tax is also not indexed to inflation, so people who sell their homes or other assets held for a long period of time pay an artificially high amount of tax on the proceeds because of inflation. So tax revenues rise, not just in nominal terms, but in real terms when inflation is high. So now you might see why the US government and the Federal Reserve don't seem to be that concerned about bringing inflation down, and they are only really starting to take it seriously now, because all the while inflation is running high, their tax revenues are increasing and their debt is shrinking, but that is at your expense. So how do you combat inflation? Well, the way to use inflation to your advantage is to do the same thing that the government is doing. Take out long-term debt. For example, investing in real estate. The real amount you are paying each month on your mortgages and investment loans will decrease with inflation as your income rises. The underlying value of properties will also rise in line with or above inflation depending on market conditions. Now, obviously not everyone is in a position to do this, and thus at a minimum, keeping your money in another type of asset that does usually beat inflation, like stocks or inflation-indexed I-bonds, is better than keeping it in cash. And right now, if you sign up for the investing app Webull, you can get 6 free stocks valued all the way up to $12,600. Luck of the draw, what you get. Link is below. Guys, please subscribe if you're new, and thank you for watching Dirty Money.